Welcome to another session of Fundamentals of Financial Management. I, Dr. Neha Seth, working in the capacity of Associate Professor with Symbiosis Institute of Business Management, Noida, a constituent of Symbiosis International Deemed University, Pune. And today I am going to discuss with you the most important topic of financial management, that is cost of capital. What is cost of capital? First of all, what is capital? This is what we have discussed in our previous sessions. Capital is nothing but the money, the fund a businessman is using to invest, to put in the business, so that he can get profit out of it. Okay. But like nothing is free in this world, so is the capital. He has to pay some cost for raising the capital. There is a cost for getting that capital that need to be invested in the business. What are the different sources from where this businessman can gather the capital? There may be different sources. The first and foremost and the most easiest way of getting capital is debt. He may get loan, he may borrow the funds, right? And when the businessman is borrowing the funds, he has to pay back to the one from whom he is borrowing. Okay. And how he is paying it back? In the form of interest. Okay. So, interest is cost of capital for raising the funds through debt. Then there may be another source from where this person can borrow, or from where this person can get the funds. This can be equity. He can raise the funds through equity. Okay. What he can do, he can go to general public and he may call for funds from this general public, and in return of that funds that he is getting, he can offer some share in the business, and the return may be given to these equity shareholders in the form of dividend. So, this amount that he is giving back to these equity shareholders is cost of raising funds through equity. Similarly, he may get funds from preference share capital as well, and in lieu of that he has to pay preference dividend to these shareholders. So, the cost of raising capital through preference shareholders can be preference dividend. So, from whatever the source of capital, the businessman, the owner, he has to repay from the investor to the investor. Okay. And the way he is paying it back to the investor is cost. Okay. So, we can say that cost of capital is cost of raising funds, cost of gathering funds. Okay. So, we will discuss about this topic in this session. In coming sessions, we will also talk about capital budgeting, okay, wherein we will see whether the project we want to start in our business, whether that project is feasible or not. Okay. So, there may be cost involved to the project, which is known as project's cost of capital. And this project's cost of capital is the minimum required rate of return on the funds. Okay. Why we call it minimum required rate? Because this is the minimum amount that we are expecting this project to give us back. This is the minimum amount that is required to keep that project ongoing. Now, suppose the project is giving us 10%, but to start that project, 10% return the project is giving us back, but to start the project we have raised the capital for which we have to pay say 12% interest. Okay, we have borrowed the capital at the rate of 12%, but the project is giving us 10%. So, that means we are suffering losses, because the amount that we have to pay for raising the capital is 12%, whereas the project is giving us return at the rate of 10%. So, from where this extra 2% will come? These are the losses. Either we have to pay it from pocket, or we are not in the situation to pay it at all. Okay, that means we are suffering losses. So, we have to choose such project, at least this project will be in situation to give us 12%, and this level is known as break even point, where we are not getting any profit, but we are not even suffering losses. Okay. So, that is why we call it, this is the minimum required rate of return on the funds that are invested in a project, and when we are calculating the cost of capital for the project, it is known as project's cost of capital. and the project's cost of capital is highly dependent upon the riskiness of its cash flows, how the flow of cash is going to be from that project. There is another term, we call it firm's cost of capital. Now, there is one firm, but this firm has multiple projects. Okay. Now, the firm's cost of capital will be overall required rate of return on investment projects. So, there are multiple projects, we will calculate cost of capital for these projects, and this overall cost of capital, this overall required rate of return or this overall minimum rate of return is the firm's cost of capital. Okay. This will decide whether the firm is able to earn profits or the firm is suffering from losses. Okay. So, we will see that how we are going to calculate this cost of capital today. Now, why do we need to study or why do we need to understand the concept of cost of capital? There are three major reasons because of which we need to understand the concept of cost of capital. First is we need to evaluate our investment decisions, and for evaluating our investment decisions we need to understand the cost of capital. Now, I decided that I want to go for this particular project, I want to start with this particular project, I need to take the decision, but my decision will be dependent upon what cost I have to pay to raise the capital to start that project. If the cost is less than expected profit or expected return, then I can start with this project. If the cost is more than the expected return, then I will drop this project. Okay. So, that is why cost of capital is required to take any kind of investment decision. Then for designing firm's capital structure, what is capital structure? Capital structure is combination of sources from where we are raising the capital. There may be different sources from where we are raising the capital. We may raise the capital from debt, from preference shares, from equity shares, but what ratio, in what ratio we need to raise the fund. We may get funds 50% from the equity, maybe 20% from preference shares, and remaining 30% we will get from debt. Okay. So, this is our capital structure, but how much has to be taken from which source? Okay. This is decided by the cost of capital. It may be possible that when we are raising the fund from debt, through debt, we are paying 10% cost of capital, but when we are raising the fund through equity, we have to pay 20% cost of capital. So, where we are getting the maximum benefit, why to pay unnecessary more cost when we are getting cheaper funds? Okay. So, what should be the ideal capital structure of the firm? This may be decided with the help of cost of capital. And the next reason or next significance of cost of capital is appraising the financial performance of top management, how the top management is performing, okay, whether we are able to go beyond break even point or not, okay, what steps can be taken, the decision can be made on the basis of cost of capital. So, that cost of capital is basically a standard for us to decide where we are and where we can go. Okay. So, that is why it is required to study, to understand the concept of cost of capital, right. So, there may be different sources from where we can raise the capital. I just now mentioned these. One can be debt. Okay. You have borrowed the funds from somebody, maybe from your parents, from your friends, or in fact, you have your savings. Now, you invested this amount in the business. Okay. So, it is, even if you are investing your amount in the business, it is not free, right. You might have invested this amount somewhere else. Even if you are putting this amount to fixed deposit, you are getting minimum amount of return. But you decided, you choose not to put this money in fixed deposit, but to start a business from this fund, these funds, these savings of yours. Okay. So, there is a cost, even if you are putting your money, there is a cost of that money, that is a cost of that capital. Okay. So, first source of capital can be debt. Okay. We can get the borrowed funds. Okay. This can be done from bonds, this can be done from debentures. Okay. And the another source of fund can be equity. As I mentioned that we can go to public, we can ask for funds, they can give us fund, and in return of that we can give them share in our company, and later we can give them dividend as well. Okay, so this is another source from where we can raise the money, raise the capital. Then we have preference shares as well. Okay, we can raise the funds through preference shares. And there is one more source of fund which is known as retained earnings. Okay, now what are retained earnings? These are separated amount from your profits that you are reinvesting in your business. Okay, your earnings which are retained with you. Okay. Again, these retained earnings are not free. There is a cost of these retained earning as well. Okay. The cost that we call is opportunity cost. So, basically the concept of cost of capital is based on the concept of opportunity cost. Okay. So, we will discuss how to calculate the cost of individual source of fund one by one. So, we will start with cost of debt first. Okay. So, when we are raising funds through debt, so this debt can be perpetual or irredeemable debt. You have taken this debt and you never need to repay this, but you have to keep on paying the cost over the amount that you have raised. Okay. For this, I am considering the example of bond. Suppose we have raised the fund from bond. For this, first we need to understand or we need to calculate the value of bond. So, the value of bond can be calculated using the formula which is visible on the screen, where the value of bond is equal to the face value, okay, and if the bonds are issued on premium, we will add the amount of premium, or if the bonds are issued on discount, we will subtract the amount of discount, or if these bonds are issued at par, we do not have to add premium, we do not have to subtract discount, the face value will remain as it is. And here in the end F represents the flotation cost. Okay, this is the cost which is incurred during raising the funds through bonds. So, this is the additional cost that is deducted from the face value to reach to the actual value of bond, right. Now, once we receive the value of bond, how we calculate the cost of debt, or I must say the cost of perpetual debt. So, the cost of debt will be equal to the interest, because the return that or the amount that you are paying is interest for bonds. Okay. So, the interest will be divided by bond value. This is how we can calculate the cost of perpetual debt. Let us understand this with the help of one example. Now, there is a company which issued 10% irredeemable debentures of rupees 10 lakh. We need to calculate the cost of debt before and after tax. Now, there is an advantage of raising funds through debt, the advantage of tax, the amount, the return is tax deductible. So, this is the advantage that we are getting. We will see how with the help of this example. Now, the company is in 50% tax bracket. We need to calculate the cost of debt before as well as after tax if debentures are issued at par, case 1, at 10% discount, case 2, and at 10% premium. This is the third case. Now, we will see how we need to solve this kind of questions if it is there with us for perpetual or irredeemable debt. Okay. So, the cost of debt before tax will be equal to interest divided by value of bond. So, interest in this case is 10% of 10 lakh, which is 1 lakh rupees, divided by value of bond, that is 10 lakh rupees. So, 1 lakh divided by 10 lakh is 10%. There is a simple formula or very basic thing to calculate cost of debt, interest divided by bond value, and here in the first case with the value is 10%. Now, this is the case when we are calculating cost of debt before tax. We are not applying the tax rate on this. Now, when we are applying the tax rate and we need to calculate cost of debt after tax, the value will be this 10%. Out of this 10%, we will multiply this 10% by 1 minus T. Okay. So, the cost of debt that we have received before tax will be multiplied by 1 minus T. So, 10 multiplied by 1 minus 0.5. 0.5, why it is 0.5? Because the tax rate is 50%. Now, when I am multiplying 10 with 0.5, I will get 5%. So, earlier when I have raised the funds through bonds, through debt, I was paying 10% when there is no tax, but if I am taking the advantage of tax, my cost of debt will be reduced to 5%. Okay, this is how the tax rate impacts the cost of debt. So, this is case 1 when the bonds are issued at par. There is another case when the bonds are issued at discount. If the bonds are issued at discount of 10%, the interest amount will remain same, that is 1 lakh, but the value of bond, you remember while calculating value of bond, we have deducted the amount of discount. So, the discount is 10%, that means 1 lakh rupees. 10 lakh minus 1 lakh, the value of bond will be 9 lakh in case 2 when we have issued the bonds on discount. So, the value of the cost of capital in this case when the bonds are issued at discount will be 1 lakh divided by 9 lakh, and this amount has to be multiplied by 1 minus 0.5 to see the impact of tax, and the value will be 5.55%. Now, there is third case when these bonds are issued at premium. Now, when the bonds are issued at premium, the value of bond, that is BO, will be 10 lakh plus 1 lakh, 10% of value of bond. So, the value will be 11 lakh. Putting the values in the same formula, 1 lakh is our interest divided by 11 lakh, which is our value of bond, multiplied by 1 minus 0.5, which will give us 4.5. So, the cost of capital when we have issued the bond at premium, 10% premium will be 4.5. So, this is how we can calculate the value of bonds, right, or the cost of capital for debt. Now, we will see the case of redeemable debt. When the debt is redeemable, that means after certain amount you have to repay that amount. Okay. Suppose I have borrowed 10 lakh rupees at debt, maybe after 10 years I have to repay that 10 lakh, but during those 10 years I have to pay interest as well, okay, interest on the amount that I have borrowed. Now, for this the formula will be, we have to use the concept of time value of money, the concept of present value that we already discussed in previous sessions here. Okay. So, interest that has to be paid on the regular basis. So, in the first part of equation, the equation which might be visible on your screen, you can see that in the first part of equation we have seen or we have taken interest amount, and we will use summation because the interest has to be paid for 10 years, and we will add these interest values for 10 years. So, the interest amount that need to be converted into present value will be interest, that is I, multiplied by 1 minus t divided by 1 plus kd. Kd is cost of debt raised to the power I. I is time period for which you have raised the funds. Okay. We will add this for 10 years. Then if there is any cost of amortization, that also need to be converted into present value, and at the end of 10th year the basic principal amount that needs to be repaid. Okay. So, this is at the end, the last point in the equation, the cash flow on the repayment of maturity, which is represented by CMN, that means the amount that you are paying back on the maturity, that is 10 lakh in our example. This also has to be converted into present value. We will divide this with 1 plus cost of debt raised to the power n, which is 10 in our case. Okay. Now, solving this equation, putting our values, it is bit complicated. We used trial and error method because you can see the KD, that the value that we need to calculate is in denominator, right. So, what we have to do, we have to randomly place some values. Suppose I am taking KD as 5%, now I am trying to calculate the value which is there on the right hand side of the equation, and I have to match the value with the bond value which is there on the left hand side of the equation. I need to do it till I am not able to match the left hand side with the right hand side, and this has to be done with the trial and error method. But there is a alternate method of doing the same thing, we call it shortcut method. Okay. Let us see with the help of example that how we can get the value of this cost of capital of debt in case of redeemable debt using shortcut method. Here is an example on your screen. A company issues 10% debentures of the face value of rupees 100 each, redeemable after 5 years. Now, debentures have a flotation cost of 2% and are issued at the rate of 5% discount. Now, what is the cost of capital when the tax rate is 50%? Okay, so everything is covered in the example that we have discussed so far. Okay, 10% is the interest rate, face value is 100 rupees, time period is 5 years, flotation cost is 2% and these are issued at the rate of 5% discount. Okay. Now, you can see on your screen, this is the formula that we are going to use for shortcut method. Okay. We are not doing it by trial and error method, we are doing it by shortcut method. Now, here cost of debt is equal to interest multiplied by 1 minus T, that is tax rate, plus redeemable value minus bond value. Okay. The redeemable value is the amount that you are paying at the time of redemption minus value of bond divided by number of years. Okay. And this whole numerator has to be divided by redeemable value plus bond value, and we have to take the average of this, that is divided by 2. Okay. Let us place the values from our example in this equation. So, this equation will look like this when we are placing the values from our example. Now, 10 multiplied by 1 minus 0.5, that is our tax rate, plus 100 minus 93. Now, from where this 93 is coming? 100 is the face value minus 5% discount, that is 5% of 100, that means 5 rupees, minus 2% is flotation cost, 2% on 100 rupees, that is rupees 2. So, 100 minus 5 minus 2 will give us 93 rupees, that is our bond value, our BO. So, we are placing this value in this equation and the equation will look like this, 100 minus 93 divided by 5. The same values 100 plus 93 divided by 2 in the denominator. Now, by solving this equation, we get cost of debt as 6.63%. Okay. So, this is how we calculate the value of bond or the cost of debt using shortcut method for redeemable debt, okay, or redeemable bonds. There are certain points that we need to keep in our mind when we are dealing with cost of debt or with debt, that debt is considered to be the cheaper or cheapest source of finance because it is considered cheaper than other sources of capital. Why? Because the debt is giving us the advantage of interest, because interest is deductible for tax sources in the case of debt. A firm does not have to pay any dividend or any earnings of companies compulsorily, okay, and debt has a maturity value as well. Interest rate has to be paid regularly and the principal sum has to be paid at maturity. At liquidation, the debt holders have the first claim on the company's assets. Okay. With this, I am giving a pause to this lecture and we will discuss remaining sources of finance in next session. Thank you for now.